Good citizens of the earth, this lovely planet, welcome to Real Turkey Show, and I'm your humble host, Atilla Yesilada, saying good morning, good afternoon, good evening, too late for you, from Istanbul. In my last video, which you can see below, I talked about Turkish financial assets. Today I'm going to broaden my horizon and talk about global financial markets. In particular, the possibility of another financial crisis or shock in the coming months. Obviously, before I do that, you want to know whether I have any credentials to talk about these subjects. So let me give you just a very brief background information about yours truly, Atilla Yesilada. I was trained an economist. In fact, I wrote my doctoral thesis on Hyman Minsky's financial instability theory, but I never got a degree. I just realized economics was hopeless. That was in 1980s in the United States. Since 1990, I've been covering Turkey and the emerging markets for my international audience, and for my Turkish audience, I've been covering the world economy. So, since I'm still in business after 31 years, I suppose I have an experience that's worth some money. That is my credentials. You may want to shut off at this point and watch something that's more entertaining or enlightening. Anyhow, I was just looking for material to sort of provide evidence for my suspicion that the world markets are really bubbly, frothy, ready to explode at any minute. And the Fed FOMC minutes came to my help. A little recognized detail that was brought to my attention by a Bloomberg article, which says that the Fed research staff defined financial risks as very high, and that's their red alert, DEFCON 5 or 1. I never figured out which one is the worst. So even though Mr. Powell is more sanguine about the level of financial markets, such as S&P 500 or MSCI World Equities, his research staff thinks, we're going to hell in a handbasket type of thing. And then suddenly things just, snowballed them. International Institute of Finance issued a report. Over the last year, global debt rose by 24.5 trillion. I have difficulty pronouncing such figures. Trillion American dollars. And the Institute expects it to rise for another $10 billion by the end of the year. To put it into percentages, the Earth owes to someone roughly 355% of its annual output. Martians, I presume, or maybe, from the planet, from the star Betelgeuse. I have no idea. But clearly, when you have such massive accumulation of debt, and which happened very rarely in recent financial history, you wonder whether it can be paid back, or whether all of the debtors can pay their debts back. Now, for developed nations like United States, Japan, Canada, EU, etc., the quandary is easy to solve. You end the epidemic or pandemic, if we speak globally, and restore growth. The economy starts growing, companies make more money, there are more employed people who pay payroll taxes, taxes go up automatically, and Bob is your uncle, you are done. In particular, in this low interest environment, debt is very sustainable. The debt to GDP ratios would be high for a few years, but that really doesn't bother the creditors as long as they see GDP per capita rising faster than the debt. So for them, the sustainability condition is simple. For emerging markets like Turkey, India, South African Republic, Brazil, China, the situation is a little bit more complicated. In addition to ending the epidemic and restoring their economies to a rapid growth path, This is my 10th video today. They also need two prior conditions to be satisfied. A, emerging market that hates a strong American dollar. B, all debt hates rising US bond yields. So we need to explore, among other things, whether the dollar can strengthen and American long bond yields, that's the yields on 10 and 30-year American government bonds, can go higher. Because if they do, that doesn't necessarily mean there will be a huge financial shock or crises, but the possibility of that increases. I am really concerned about this situation because, in Google, look Bagehot, a 19th century British economist, who said, and I don't quote exactly, it's just my words, when greengrocers and chambermaids rush into the stock market, a crash is coming. And we live in that kind of a world. Why does Tesla buy Bitcoin? Okay? I mean, I'm not against Bitcoin or any other cryptocurrencies. But why would Tesla buy it? I mean, they produce electronic cars and space rockets, as far as I know. And that's the problem. This GameStop thing, the Reddit chat platforms, etc. We see the same thing in Turkey. More than 1 million amateurs started buying and selling stock over the last year. It's everywhere. People whose business is not financial investing are risking their money in financial assets that they don't even understand. 2, complacency. JP Morgan complacency index is at a 20-year low. That means people are just very comfortable about where the markets are. When everyone is worried, even if markets are rising, you won't have a financial crisis. The problem starts when everybody lets down their guard. So, to me, with the exception of a strong dollar and rising American yields, the atmosphere or the soil is conducive, fertile for a financial crisis. So now let's look at theory and practice to see whether dollar index can go up higher and American yields can rise. The near consensus is for the dollar to weaken. And in fact, not for a few months, but for a prolonged period. And that consensus is derived from the traditional balance of payments approach to economics, which says if a country has high and rising current account deficits and high and rising budget deficits, its currency will depreciate. I have nothing to disagree with this theory. But it is not the only theory. And it doesn't explain all the observed facts. There's another one, the portfolio theory of global financial flows, which says money will flow to countries or to assets which offer higher yields or returns. Well, guess what? That country also happens to be the United States, because that budget deficit is going to stimulating the economy. Fed is printing tons of money. I don't know how big their balance sheet is. It might be infinite. It might be as big as the observable universe. And of course, assuming United States manages to vaccinate enough people by May or June to reach herd immunity, it has a very high savings rate, which will produce pent-up demand, which means people have saved not because they thought it would come handy, but because they couldn't find anything to spend it on. I mean, if you're stuck at home, you can't go out and party. So suddenly we may see the spillover of demand into goods and services markets, which would generate inflation. Also high growth. High growth means companies making more profits. So to me, the consensus may be wrong. I mean, they might be right if despite all this monetary and fiscal stimulus, the American economy tanks over the summer. that's when I would think dollar index depreciating. But if United States is ahead of the recovery curve, vaccination curve, and inflation vis-a-vis Japan and the EU, the dollar index will appreciate. Again, rule of thumb, not a precise ratio, but if the dollar index, which is currently around 90.5 or so, remains in the range of 90 to 95, I don't see a huge danger for emerging markets or America's junk bond market, which is also very, very bloated. But if the dollar index goes above 95, I would be extremely worried. Two American bond deals. I'm sure if you have any interest in economics or finance, you may have caught a few headlines about American bond deals rising. In fact, when I start shooting this video, which is Friday the 13th, Friday the 19th, anyhow, they were at one point, the 10-year American bond yield was at 1.3. So I did some research on whether this is high or low, and this is my findings. At this level, the bond yield doesn't have much of an influence on financial stability or S&P 500 or any other risky assets. There are certain conditions under which rising bond yields could be destabilizing for risky assets and equity markets. A, and I'm quoting from Financial Times, if bond yields start rising at, say, 30 basis point clip each month, which means the bond yield, 10-year bond yield going from 130 to 160 in a month, that would severely undermine confidence in equity and risky asset markets. Two, for some reason, many analysts that I consulted consider a yield on the 10-year bond of 1.75 as a critical threshold, which, if exceeded, would severely increase the chances of a bear market in the equities, on the equities side. I don't know why that's a critical threshold, but I'm sure there's some math behind it. And finally, currently long-term inflation expectations as measured from inflation-protected bonds is 2.4%. Experts claim if this goes up to 3%, then other risky assets would be subject to severe pressures. Are these possibilities? Well, let's theorize. I mean, if Biden gets the go-ahead from Congress to spend $1.9 trillion, Fed continues to print money, and the pandemic is under control by summer, I don't see why inflation won't rise in the United States. And if inflation or inflation expectations rise, yes, we can reach that level. In fact, we can go up to 2% or so. It could be very sudden. This is how inflation works. I mean, for a long time it's dormant and suddenly expectations change and we see an overshoot in inflation. So I can't assign a probability, but bond yields inching up to 175 or 2% is a likelihood in the good case scenario. Now, once again, maybe slightly technical, but most of you might have heard that if that happens, Fed can deploy yield curve control like Bank of Japan, which is simply saying the Fed guaranteeing that the yield on 10 and 30-year American bond yields will not exceed a certain level. It sort of puts a ceiling on yields. In Japan, this is 0 to 0.1%. In the United States, I don't know. But you see, there's a problem there. To be able to guarantee a fixed yield to investors on a bond, you need to be ready to buy infinite quantities of it to increase its price and reduce its yield, which means you have to print even more money. And what happens if you print more money? Well, one of the two things happens. Either it spills into the goods and services markets, you get more inflation, or it spills into financial markets and you get a bubble. So Fed cannot at the same time work towards full employment and do yield control. It's as simple as that. So, having said all of these, well, when are these things likely to happen? I'm not saying they will happen, but I'm really concerned about May and June. That's the time when the world will find out whether COVID-19 is firmly under control with no chances of making a comeback in the winter. If that's the case, then yeah, we're going to be dealing with a sudden jump in inflation, higher bond yields, and defaults in American junk bond market and emerging market among fragile emerging markets, and Turkey could be one of them. Or I will be right, and by late May, June, the world will see that COVID-19 pandemic is better. Unfortunately, there are mutant viruses which require frequent revaccination, and parts of the economy remain closed down. Global travel is still restricted, etc., etc. In other words, things will be better, but not as good as the financial markets are pricing right now. And then, of course, there will be an adjustment, a repricing. So, May and June, extremely, extremely important. Either the world economy will get better and the financial markets will have to deal with inflation, or our expectations about a sustainable recovery will fall by the wayside, and we will have a default crisis or possibly even deflation. The second key date is the beginning of 2022, because even though the Fed is committed to overheating the economy to make sure that everyone who wants to work can get a job, which is an admirable goal, I fully support it, there are certain hawks in the FOMC, in the Monetary Policy Council, who would make their objections known through the press that the cost of reaching full employment in terms of inflation and financial stability is too high. And if and when that debate starts in Fed, the financial markets will spook. There will be something like a taper tantrum, which happened in 2013, I believe, when Bernanke said we might be exiting quantitative easing. For 8 to 16 weeks, depending on the market, there were severe sell-offs across the world. Okay, so I completed my promise. For whatever it's worth, I have explained both Turkish assets, the video is below, and my view on the global debt burden and the possibility of another financial crisis. I want to thank you for watching another Real Turkey video. I read your comments religiously. Are there subjects that you want me to talk about or invite experts on? It could be, for instance, PKK, Fethullah Gülen, Turkey's Kurds, Turkey's economic fundamentals, monetary policy. If I'm not an expert, I shall consult and invite an English-speaking expert. And of course, if you like our videos, please share them so that we can have a bigger audience. Thanks for watching Real Turkey channel. This is your presenter Atilla Yesilada saying goodbye from snowy but sunny Istanbul.